Hello, everybody, and thank you for tuning in to Nutmeg's Market Update with Q&A. I'm George Mitten, investment writer here at Nutmeg. I'm here with James McManus, our Chief Investment Officer, and Brad Holland, our Director of Investment Strategy. We've put together this webcast to answer some of the questions that you might have about what has been a very eventful few days in the markets, coming on top of a very eventful few weeks. James and Brad are going to give you a short presentation explaining their perspective on recent events, namely the sudden fall in the oil price and the ongoing concern over the coronavirus. They'll also talk about their investment approach, how to handle market volatility, and perhaps they'll give us a few tips about how the rest of us might handle this current market volatility too. Now, we've had some great questions coming in already, and I've got a long list which we're going to come to after the presentation in about 10-15 minutes time. If you do have any more questions, please do send them to us. You can, if you're watching on Zoom, you can use the Q&A feature to send us your question. We're also streaming this webcast on Facebook Live and YouTube. If you're watching on either of those channels, we won't be able to take your questions live, but we will do our best to respond to you if we feel that your question hasn't been adequately covered in this session. So leave your question there as a comment. If you don't have a question, please also just leave us some feedback if you have any. We're very grateful to hear any of that, and that helps us as we continue to communicate on these and other topics in the coming days. One more thing, this webcast will be archived on Facebook and YouTube, so you'll have a chance to watch this video again if you like. Okay, that's enough from me. I'm now going to hand over to James, who's going to take us through what's been going on. Over to you, James.
Thanks, George. I'd like to also echo that welcome and thank you all for taking the time to dial in today, and of course for being a Nutmeg customer. We have a short presentation, as George mentioned, and we're going to follow, look at a number of areas as outlined in this agenda, and then really we intend to dedicate the bulk of the time today to answer customer questions. So let's start with what has been happening in markets. And if we wind back to the beginning of the year, we were really constructive on the outlook ahead. We had begun to see the green shoots of growth again in some of the economic and trade data coming out of Asia. And although some European economies finished the 2019 full calendar year with really lackluster fashion, the US economy remained in robust shape. And so what's that since changed, and why have financial markets seen such strong moves? Well, there's been two major supply and demand shocks that have begun to play out in financial markets. Firstly, investors globally really underestimated the risk from the COVID-19 outbreak in a number of ways, believing that the outbreak would largely be contained in China, that it would only cause a temporary economic disruption, and that containment measures would not constrict activity in the medium term, i.e. that there would be a simple short-term resolution to the problem. Now, towards the end of February, markets began to become more concerned over the global spread of the virus, given the actions taken by governments to contain it that were constraining economic activity, and the subsequent impact that that had on consumer sentiment. And that's really caused investors to reassess the balance of economic risks, and consumer sentiment in particular has been hit really hard. Now, secondly, over the past week, there's also been a failure by OPEC nations and their allies to agree a collective strategy when it comes to managing the world's oil supply, and importantly, managing the price of oil supply. The dispute between Russia and Saudi Arabia has resulted in Saudi Arabia now significantly increasing the supply of oil to the market, and at a significant price cut, meaning the price per barrel of oil has dropped significantly in only a very short period of time. Now, falling oil prices are not always bad news, and we'll come on to discuss this. But again, investors have been forced to rapidly reassess the risks in the face of what has been a significant shift in the supply and demand characteristics of one of the world's largest commodity markets.
And you can see here that this is not the first virus crisis, nor the first oil shock. The grey bar shows the SARS outbreak in 2003. That caused some volatility because it came after years of other corporate and geopolitical crises, but the market, therefore, impact was not as huge. James has mentioned the impact this time around has felt worse because it started with markets at higher valuations and because it was not initially expected to trouble regions outside Asia. Now, the blue shaded regions are the oil shocks we've seen in the past, where prices fell actually 70% on each of those occasions. Clearly, though, there were other things going on in each of these periods. In 08, 09, that was a global financial crisis where equities fell 50%. In 2015, the China stock bubble collapsed and equities fell 14% on that occasion. This time, oil prices have fallen 40% in 2 weeks and 30% in a single day. And world equities are close to 20% off their recent highs.
So a quick word on what a lower oil price really means. And as you can see from this chart, dramatic rises and falls in the oil price are not really as rare as they may seem. And it's really important when looking at oil prices to consider both sides of the equation. So clearly when oil prices fall, that's bad news for companies and countries that rely on oil as a primary revenue source, as a revenue generator. The energy sector, for example, accounts for around 4.2% of developed market stock markets, and therefore the revenue impact of a large drop in oil price will be keenly felt by those companies. But the energy sector is also a larger part of the corporate bond markets, and so investors will be seeking to understand what a fall in prices means for the creditworthiness of those borrowers, which is likely to also result in higher interest rates or yields for energy companies, which in turn is bad news for those invested in their bonds. But a lower oil price is also akin to a tax cut for consumers of oil. Oil is a key input commodity in the production of materials and the transportation of materials globally, meaning that a lower oil price should actually facilitate lower cost trade. So everyday consumers will tend to benefit as lower oil prices mean greater purchasing power and also savings at the fuel pump.
So what do we expect to happen now? Well, the slowness, I've ordered here 3 responses in order of their priority. The medical policy response, the fiscal response, which is government taxes and spending, and the monetary response, which is interest rate settings and emergency lending into the economy. Now, on the medical policy response, there has been a slowness of response in the Western nations who were caught off guard. Now, there have been efforts to make up for lost time, but it's difficult to see how some countries, particularly those without centralized health systems, can really make up for lost time very easily. And the example here is the US. So the question remains just how disruptive these actions need to be in order to be effective. And so fiscal response is hugely important in terms of smoothing out the economic costs of these crises. And although they're light on detail, certainly strong on promise that governments are very committed to maintain the economic growth trajectories they were on late last year. And fiscal policy will certainly be a main vehicle to enact this, and expect to see a lot more announcements on this in coming days. On the monetary policy response, central banks around the world have been acting to deliver stimulus already, but they are very aware, as are we, that the burden needs to fall on fiscal policy. Coordination has not yet been forthcoming, but emergency policy is definitely being enacted so that financial markets don't actually amplify the shock that's going on in the real economy. Now, the US is a lead central bank here, and it's already set the tone by an emergency 50 basis point cut, and we expect more cuts from the US bank as well.
So markets have clearly been volatile, both equity markets, bond markets, currency markets, and indeed, as of this weekend, commodity markets as well. So how have Nutmeg portfolios been positioned for this? Well, going into the year, as we mentioned, we were becoming quite constructive on the outlook for global trade again. We had a neutral equity position. That is, the levels of equity exposure that we held were aligned with what we would expect to hold at each risk level over the long term. However, we now hold less equities than we would typically do so over the long term, and that's predominantly due to the near-term uncertainty that we're facing, and what we see as a reasonably short-term delay to the recovering the global trade story that we begin to see developing at the beginning of the year. From a bond perspective, we continue to maintain the levels of bond exposure that would be expected in portfolios over the long term. So we're neutral in our terminology. And that's despite their really strong performance year to date, particularly US Treasuries have had a stellar 2020 or a start to 2020. So they can feel quite expensive versus their historical norm, but we think they've really served portfolios well as a safe haven in what has been a volatile environment. And the continued near-term uncertainty around COVID-19 makes them a valuable addition to portfolios on a longer-term basis. However, we continue to favor US Treasuries over UK government bonds, and that's because the starting yields for those bonds were much higher before we saw movements down in yield. And we continue to hold more cash in portfolios than we would be expected to do over the long term. So this is really a factor of two things. As government bonds have performed really strongly, we've trimmed that exposure down in order to manage risk, to make sure that we don't become overweight bonds. But we've wanted to maintain an underweight equity position in portfolios. So holding cash allows us to better balance the risk and reward in portfolios as we move through this period of volatility.
So I want to, in the next couple of slides, talk to you about how we should behave when markets are volatile. It's a theory of investor behavior and also the practice of how our Nutmeg customers have behaved over recent years. Now, this chart here shows the theory of that the volatility is really your friend if you are a long-term investor. Now, on the chart shows 10 years of experience when volatility has been high. And what you see on the left-hand scale is the return on US stocks over the following year. The average of those returns has been about 20%. Now, we can't guarantee that given this high volatility experience we're now experiencing, that the next 12 months will see 20% returns. But what this chart does show is the returns investors can miss if they cash in their investment when volatility spikes. The theory is that long-term investors in a balanced portfolio should expect to see higher long-term returns in a higher risk, higher volatility portfolio. Well, that's the theory. How have Nutmeg's customers behaved around periods in the past of high volatility? Well, there have been several serious periods of stock market losses since Nutmeg began its online revolution in investing, from the Eurozone crisis in 2013 to the latest coronavirus crisis. Now, the left-hand column in the table shows the 4-week losses experienced in those periods. And the other data shows how Nutmeg customers responded to that volatility. Now, on average, 0.2%, that's right, 0.2% of our customers closed down their portfolios in the ensuing 4-week period. That's the second column. And about 1% of customers increased their risk on average, and a little bit below that reduced their risk. But the real tribute to Nutmeg investors is that 98% of them did nothing at all. They stay invested for the longer term.
And so finally, to reiterate, it's really important to ignore the noise, the market noise, the headlines in volatile periods, to focus on your medium and long-term investment goals and to exercise really good investment discipline when it comes to market volatility. So our portfolios are diversified at Nutmeg. Our fully managed portfolios are built to take into account the balance of risks to the medium-term outlook at any given time. And we know that timing the market is incredibly difficult, even for professional investors. So I'd like to leave you with this one stat to illustrate that before we open up to questions. Now, it's impossible to know ahead of time which will be the best and worst days in financial markets. But to illustrate that volatility can mean upwards moves as well as downwards moves, consider this. In the past 20 years, if you remove the best 10 days from the S&P 500's performance, your return would fall from around 183.7% to 41.6%. The lesson here is that investors should focus on time in the market over the long term, rather than timing the market in the short term. And with that, we'll conclude this short presentation. Thanks for listening, and we'll now open to questions.
Thank you, James. Firstly, I hope that was helpful to everybody. We'd love to hear your feedback. I've noticed quite a few people chatting on the chat feature on Zoom, which is really helpful. If you have any other thoughts, please share them. Please do share them on Facebook and YouTube if you're watching on those channels. You can always contact us directly too. We'd love to have an email from you or another kind of communication on social media channels. So we've had some great questions coming through during the webcast, but we also collected quite a large number before we started. So we're going to start with a few of those. Now we've grouped these by theme so that we can try to answer as many of you as possible without repeating ourselves. So the first theme, so lots of people want to know what our investment team are doing to mitigate losses. Thanks to Madeline, Scott, Charlotte, Humdul, James and others for their questions on this theme. James and Brad, can you tell us a bit about what you're doing to minimize the losses?
Yeah, sure. So I can take that question. So, you know, at Nutmeg, we're active in the management of our fully managed and socially responsible portfolios. That doesn't mean, however, that we react to markets. It's about balancing the risk with the opportunity set at any given point in time. And as mentioned, we've adjusted our bond and equity exposure where it's been appropriate to do so. You know, in bonds and in equities, that's included taking some gains in positions that have delivered strong returns for portfolios. And holding the current level of cash that we do is defensive, but it also allows us to be responsive to developments in the market. At the current time, you know, the COVID-19 outbreak is unpredictable in its nature. But our view is grounded in the medium term. We'll always manage the risk reward balance in portfolios near term, but we take a medium to long term view when we construct how our portfolios are positioned.
Okay, thank you very much, James. Another topic, and we're seeing quite a few questions coming in on this live as well, is about what investors themselves should do. Should they be taking action? A popular question is about changing the risk level on Nutmeg portfolios. Thanks to Debbie, Andrew, Lee, and others for questions on this. I'm going to read out one specific question, which comes from someone called Faye. I'm in the process of buying a flat and I want to use the money I've saved in my lifetime ISA as my deposit. It's now less than what I've saved. Do I need to move my money to a less risky investment pot? I can't lose that money. I think many of us can sympathize with Faye there. So Brad, what would you say in response?
Well, generally we would say that a risk level is appropriate if your situation has changed. For example, you now have a different goal or time frame. Another reason would be if your investment goals have been hit ahead of time. Always wise to take your cash out at that point as well. Otherwise, good investment discipline is required. You know, you are rewarded for exposure to markets over the long term. We've seen how our own customer base behaves very well around volatility times. Volatility is your friend, actually, in the long term.
Okay, thank you, Brad. So connected to that question, obviously lowering your risk level is one way that people sometimes are tempted to do at this time. Perhaps a more extreme route is actually to lower your risk as far as possible by moving investments into cash. We've had a lot of questions on that theme. Josh, for instance, asked us if investing in cash is a better option than investing in the markets at the moment. What would you say to that? Is this a good time to go into cash, James?
So, you know, timing the market is incredibly difficult. When we look at the 25 best days and the 25 worst days in, for example, the S&P 500, the US stock market over the previous 20 years, what we see is a pattern of coincidence. That is that they tend to be grouped together, the best and the worst days. And that's because markets have a tendency to overreact to uncertainty. And that's why it's really important to stay the course and to ignore the short-term bumps and ride out the volatility, if you like. We, as I said, I mentioned before, we actively manage our fully managed portfolios, which means that the balance of risk to the outlook will already be reflected in your investment portfolio because our investment team here at Nutmeg is doing that for you. So you shouldn't necessarily feel the need to de-risk and go to cash. You know, as the final stat in the presentation showed, it is really important to be exposed to markets in the long term in order to generate the returns you need to hit your goal. Market timing is difficult. We see that the bulk of returns can be generated in a very small window of days, but the timing of those days and understanding when those days will occur is very, very difficult. ex ante, as in beforehand, before the event takes place. So staying in the market, being exposed to markets and to volatility in the long term will help you generate the returns you need over the life of an investment in order to reach your investment goals.
Thank you, James. You sort of gave a good segue there into another theme, and we're getting a lot of questions from viewers right now about this theme. So the last couple of questions dealt with the sort of more risk-averse side. It's a very volatile period, so people are asking if they should lower their risk level or move into cash. Many of you are asking, on the contrary, is this actually a good time to buy investments? Thanks to Andrew, Hamza, Martin, Tanuj, and Anthony, among others, for questions on this. Basically, these viewers are taking a more optimistic view, and they're saying that since the recent stock market falls have made investments cheaper, maybe now is a good time to invest cash in the markets. The question there, of course, is, have we reached the bottom? What's your view on that?
Well, that's the obviously a very difficult question to answer. Have we reached the bottom? It's also as difficult as have we reached the top. And so, as James has been saying, the stats show that it's very difficult to be out of the market during the key up moments. So staying invested through the volatility is always the best advice. What we've seen from our customer behavior, though, is that as many people who are reducing their risk levels during volatility are raising their risk levels during volatility. And our customer support often get asked this question, is now a good time to be putting money into the market? And we think, over the long term, it is a good time to put money in the markets if you have a long-term horizon. Clearly, the market has fallen from the last month, so it's better priced today than it was a month ago. But certainly, if your outlook is long-term, it's always a good time to invest in the market.
Thank you, Brad. Connected to this question, there is a rather large and important deadline coming up in the investment and financial world. That's the end of the tax year here in the UK on the 5th of April. Some of our customers and some of our viewers have asked, connected to the question of should I invest now, they've said, if, for instance, they want to invest funds into an ISA, can they do so now? Can they, for instance, move money into their ISA while keeping this year's ISA allowance? Do they have to invest it in the markets now, or can they hold that in cash? So, question about how our Nutmeg portfolios work there, James.
Yeah, so I guess in some ways similar to the previous question, in the sense of, is now a good time to put new capital to work in the financial markets? I think the answer is you can use your ISA allowance. You can pay into, for example, in Nutmeg, you can pay into a cash pot. If you wish, you don't have to pay your capital straight into the market. And maybe this point will speak to those of you who asked the previous question as well. Again, we don't encourage timing the market, but if you're concerned about investing a lump sum, if you have a particularly large lump sum, or you're worried about the effect that making one payment into the entry point into the market can have over your investment journey, then we do actually have a feature in Nutmeg called Drip Feed that allows you to automatically drip your money into the market from cash. So you set up a cash pot, and then you set up the frequency with which you'd like to invest that into the market, and the system will take care of that for you automatically. So in other words, it'll allow you to pound cost average into your investment. And that can be an effective way for people who are worried about paying in at any one given point in time, to actually spread out those payments over time, but also allowing you to make the most of that ISA allowance before the deadline on the 5th of April.
Thank you, James. Okay, we've talked a little bit there on the sort of more personal finance angle. We're also having some great questions coming in more on the sort of global picture. Obviously, James and Brad have talked a little bit about coronavirus, but we were having some more questions about that. John, for instance, has asked, do you have a view about whether we'll see more market falls if and when the virus spreads further? And again, I think this has been touched on, but perhaps you could say a bit more about the government stimulus packages that we're expecting that might help to improve things, Brad.
So yeah, I did mention the stimulus packages in the slide deck, but so we do expect those things to happen. Fiscal policy is, of course, the most important thing after the medical policy response. It's entirely possible the markets will see further volatility from here. I mean, there is an element of the unknown to COVID-19, and it makes it difficult for us to make predictions. But we are managing those risks, the risks of, on the one hand, the escalation of the COVID-19, and on the other hand, the positive effects that come out of stimulus measures when they occur. We can also look to the profile of the disease in Asian nations to illustrate the likely recovery profile. We're seeing good recovery profiles in China and maybe even in South Korea at the moment. And we judge that against the impact also of the economic policy that will take place in between time.
Thank you, Brad. Okay, another common question that we've been getting is to do with the kind of assets that people call safe havens. So the kinds of things that people buy in very volatile times because they tend to hold their value. These are things like government bonds, but also things like gold. Gold is often used as a hedge when the stock markets are falling. So several of our viewers have asked about gold. What, are we doing things with gold? Is there a way for Nutmeg customers to invest in gold, James?
Yeah, I can take that one. So we've actually written about gold and this topic extensively on our blog Nutmegonomics in the past. And in a very short summary, our view is that over the long term, a long-term holding in gold can actually be quite costly to portfolio performance, but it is potentially very useful as a safe haven asset from time to time, particularly when markets are volatile. And previously we thought it was useful as an inflation hedge, although we believe there are other inflation hedges we can put into portfolios that may be more effective. I think gold, when you look at the performance of gold over the previous 12 months, it has performed quite well. But it hasn't necessarily performed extremely well in the past month, and the performance has actually been quite mixed during this period of volatility. So what we saw was the gold price sort of rally up into the run-up in the volatility, but actually in the midst of some of the most volatile days, actually gold didn't rally. It did lose some of its value, and therefore it hasn't played the same safe haven role that it is necessarily seen as a core characteristic over the long term. So, for Nutmeg portfolios, we actually took the view that we wanted to own US Treasuries, particularly long-dated US Treasuries that have a higher duration. Duration is interest rate sensitivity. So what that means is that when we get potentially lower interest rates, actually the 30-year bond has a higher interest rate sensitivity, provides us more protection in a volatile market environment. So we've chosen to own treasuries. We wouldn't rule out gold from our portfolios. Actually, I think ETFs are one of the best ways anybody can buy gold. Physical gold is an incredibly expensive asset to own as an investor. You wouldn't want to own that as an individual investor because you'd have to take care of all the things that come along with it, the security, the insurance, the custody. What ETFs allow us to do is they democratize access to that asset allocation. They allow us to own gold in our portfolios, even if we want to own just a small part and not a whole gold bar. So for us, wouldn't rule it out. US Treasuries have performed really, really well as a safe haven in this crisis, though.
Thanks, James. I imagine many of the people that are watching this webcast know very well what an ETF is, but in case you're not aware, that stands for Exchange Traded Funds. These are the principal investments that Nutmeg uses to build your portfolios with. If you'd like more information about those, again, we've written extensively about ETFs on Nutmegonomics and why the investment team think that they're a very useful, efficient way to invest. We had some questions earlier about ethical portfolios. As many of you will know, Nutmeg offers a socially responsible investment style. Nick and others have questions about this. If you as an investor is invested in a socially responsible portfolio, to what extent are you exposed to the effects of oil? I mean, many people might be thinking that if they're invested in sustainable energy and so on, the oil price ought not to affect them too much because perhaps they're invested in wind and solar instead. So could perhaps we talk a little bit about socially responsible portfolios? Are they still affected by things such as the oil price?
Well, during periods of shock, yes, I think they definitely still are. And this is less about style of investing. What we're going through right now, it's much more about the markets being spooked with the uncertainty and trying to understand the consequences and fallout. Socially responsible portfolios have performed well, and their lower carbon intensity should help them during oil shocks. But all investments are affected by such a move in one of the world's largest commodity markets, and also obviously in the overall uncertainty that's hitting markets at the time this point in time.
Okay, thank you, Brad. We've spoken a bit about socially responsible portfolios there. Many of the slides earlier, when the investment team are talking about the changes that they're making or have made, they tend to think about the fully managed portfolios. First, they're our largest investment product, but of course, many of our customers are invested in the fixed allocation portfolios. And we had a question about those. These, by the way, are what we call our set and forget option. You invest in a fixed allocation of assets rather than the fully managed and socially responsible options, which are overseen on a daily basis by the investment team. A viewer named Nick has asked, as a result of recent events, which have been quite extreme, will you be reapportioning the fixed allocations between different indices in those fixed allocation portfolios, James?
Sure, it's a good question. So the fixed allocation portfolios have something that we call an automatic rebalancing frequency, and that's customized to each individual portfolio. So put simply, there are fixed weights for assets. Those are the weights at which your money is invested. And then once your portfolio has moved a set distance away from its starting point in terms of risk, our proprietary systems then ensure that it's rebalanced back to those initial weights, back to those fixed allocation weights. Now, we review those strategic weightings once a year, but outside of that, we don't make changes to those portfolios. They're called fixed allocation for that exact reason, that the primary allocation does not change over the period of 12 months. And in fact, actually, those fixed weights are based on a considerable period of history, so that when we add in a new 12-month period each year, it shouldn't materially affect the weightings between different asset classes. So in a simple answer, we won't be reapportioning, but your individual underlying portfolio could well have been rebalanced if it has moved far enough away in terms of risk from its starting point.
Interesting. Thank you, James. Again, this is a slightly more technical question about how Nutmeg works, how we manage investments for you. So a number of people had understandable questions about Nutmeg's trading cycle. Abby has asked, if I invest today, when exactly would the funds be deployed? On the other hand, we also have customers understandably would like to know if they withdraw funds or ask to move to cash, how long will it take us to complete on their instructions? So could you tell us a bit about how the trading cycle works, James?
Yeah, sure. So I can jump in on that. So typically we trade twice a week at Nutmeg. This allows us to manage our customer cash flows. It also allows us to drive economies of scale in transacting in underlying ETFs. So a lot of ETF transactions take place in a manner that's called over the counter. That's between specialist counterparties. And actually there are economies of scale in the ETF market. So the bigger the amounts that you're buying and selling, typically the better the price you're able to achieve. And another reason for us to bulk those orders together is also because we net customers' trades across our client base. So if I was withdrawing because I've completed my goal and you're investing today because you're a brand new investor with Nutmeg, actually we don't need to undertake those trades in the market. We can net the trades off between our existing investor base and save on the cost of trading in the market. So the twice weekly trading cycle, it can change days, but it's really there to discourage overtrading and market timing, as well as driving economies of scale. In terms of when your cash will actually be deployed, as soon as it reaches us, it will be deployed in the next trading cycle. It depends on how you would pay in, whether that's via debit card or faster payment. But typically, once the payment receives us, the payment is received by us and the instructions received, then we'll put it into that trading cycle that day or later that week, depending on when the next trading cycle is.
Okay. Thank you, James. Okay, we had another interesting question, I think, about the nature of the recent stock market sell-offs. Ali says, and I quote, "All experts and commentators say you should not sell in a downturn, as you are simply realizing a loss when equity investing is for the long term." That Ali is absolutely right. That's exactly what the investment team here say. So the question is, in the recent volatility, who has been selling to cause prices to crash, and why? Over to you, Brad.
Yeah, actually, that is a very good question. I guess we can answer that in sort of three ways. Now, the first way is to say, well, a lot of volatility is created actually by traders themselves, not investors. Now when market sentiments deteriorate, say that some bad news comes out, or there's a bad day, a bad afternoon price action, traders can exaggerate that by offering poor prices in the market, and those poor prices themselves can generate further fear and so on. So the spiral goes. So the spiral goes. A second way is to say, well, think about the fact that there are different types of investors. So there are not every type of investor is rationalizing what pure value is from one day or 1 month to the next. And because you're right to say those sort of investors shouldn't be doing this sort of buying and selling, or rather selling. But there are other types of investors who are just following algorithms, and now those algorithms are picking up feeds of news feeds, price feeds, and they're just selling by a direct relation to what those feeds pick up. And so those algorithms can cause volatility to be exaggerated as well. Stop losses can also come in. Some customers put in stop losses, and so when the market goes past that stop loss, those sell orders get executed, and so on. So the spiral can go on further, creating more volatility. So yeah, a third way would be that actually, well, it might just be the case that some investors aren't exercising good discipline. I showed you the slide about how our customers themselves are very disciplined indeed about not responding to volatility, but not all investors are like that, and a lack of a good process can lead a lot of investors to rely on their gut feel, which is to avoid pain and to sell the market.
Thank you, Brad. We've got time for a couple more questions because we were going to do half an hour. We've already overrun a little bit, but we've had a good question that James would like to have a crack at answering, which has come through one of our viewers today using the username CT. And they have asked, should we be concerned about credit risk tightening as we see firms become distressed if the coronavirus continues to disrupt the economy? So over to you, James.
Yeah, so very good question. I think this is one of the concerns on the forefront of investors' minds, not just at the moment, but always is there in most investors' thinking around credit risk. And there's lots of different ways you can think about that. You can think about the effects of consumer credit and the feedback loop to the wider economy. So, when we think about what could be damaging from an activity shutdown in any nation, what could be damaging is the activity shutdown restricts cash flows both for businesses and consumers. Now, when we think about coronavirus, that's something that's top of mind for many investors. But I think when you refer to distressed companies there, I assume there's maybe a reference to the likes of Flybe and others that are already quite distressed in their current state. So, there's less concern about, good companies today becoming distressed tomorrow because of temporary shocks to activity. But these episodes do tend to shake out some of the apples from the tree, if you like, in terms of the less appropriately positioned companies. I think one really interesting area to look at if we see further shutdowns or quarantines in certain nations, particularly in the US, is areas in consumer credit, where there isn't statutory sick pay in the US, looking at what happens to car loan defaults, things like that will be really important for determining what the impact is on the end consumer. But we should point out at this point, we've had a long drawn out period of low interest rates. Companies have borrowed quite a significant amount, and there is leverage in the system. But actually, the sustainability of that debt is of a very different profile to how it was prior to the global financial crisis. And actually, low interest rates have allowed businesses to borrow at really sustainable levels. So it is something we're looking at. It's something that we always keep an eye on. But it's outside of a number of key pockets, isn't something that will come to fruition overnight.
Thank you, James. Okay, we've got another question here from one of our users, one of our viewers on Zoom, who's elected to remain anonymous, but they have asked Brad if Brad could elaborate on why volatility is your friend in the long term. I'll pass it over to him in just a second, but I'll just give a quick plug to a video that he did some time ago, which is on the Nutmegonomics website, where he also lays out some of his thinking on this. So have a look at that video if you're interested, but over to you, Brad.
Well, I guess there are really two rules of thumb that are always and everywhere true. One is that past performance is no guarantee of future returns, and the other rule of thumb that's always true for markets, that in the long term, the higher the risk, the higher the return you should expect to receive in the long term. And so therefore, the higher the risk, the higher the volatility, the higher the return that asset should deliver to you in the longer term. Now, there's two caveats to that general rule. One is that it's in the long term, in the long run, and the other is that it's in a diversified portfolio. So if you have a long-term horizon, and if you own a diversified portfolio of assets, then the higher amount of risk you can take would lead you to rightfully expect a higher return in the long term. So patience is crucial. It always feels tough during those periods of volatility, but patience pays off in the end.
Thank you very much, Brad. I'm afraid I'm going to have to draw an end to the webcast now. The guys here have to get back and get back to work. But I want to say thank you to everybody who has tuned in today. Thank you for watching. We've done our best to cover all the questions that have come in, but looking at the list, there are a few that perhaps we haven't been able to cover in depth. So we're going to be thinking about other ways that we can try to answer your questions in our communications going forward. So if you've enjoyed this webcast, let us know. If you'd like more of these, let us know. We're going to be taking your questions and looking at some other formats that we can use to reply to them. So please do engage with us. We know it's whenever the markets are like this, it can be a concerning period, and that's why we want to do our best to answer your questions in the hope that information is power. Thanks once again for listening. Again, send us your feedback, and that's it. Thanks and goodbye.